This week had everything, from the weekend trap into the false move week beginning to traders being caught off guard by a surprise news event in the dead gap zone. But inside TTC, we were ready. From macro heads up to live scalp setup, the system held strong and the community nailed it. In this week's wrap up, I'll walk you through the full price action story from Sunday through to Thursday and show how, even though it wasn't a clean 3-day swing, the structure still followed the model. We've had 2 days of consolidation, but that doesn't mean we're off track. In the TBD system, retraces or boardroom phases are expected between levels. I'll break down how our team stayed clear-headed, how the community helped each other stay patient, and where the model continued to guide us even when things looked choppy. You'll see our live session trades, chart updates from Annie and the team, and some macro insight that gave us the confidence to trust the model, not the noise. Hi, my name is Janet and this is Trade Travel Chill. If you're new here, welcome. If you're returning, welcome back. Be sure to hit the like and subscribe button so you can be notified every time I upload a new video. Let's get into it. On Friday, Asia initiated the move to the upside, with the US session initiating the high of the weekend trap box. We then got sideways consolidation, which is to be expected during the weekend. On Sunday, before the market reopened, Annie put out an update giving us the heads up on what we should be expecting once the market reopens. She then put out a chart update for the community following on from that video on how false move week beginning should play out. But how could we have been on top of the game in knowing that this breakout was going to happen to the upside? So let's rewind and have a look at this weekend trap. We know that when price is going sideways or consolidating, the volume is low, whilst the open interest is increasing. This signals a breakout is incoming and a stop hunt is not necessary. So we can see that when the market finally reopened around Sunday 5 PM New York, we created a higher low compared to this point here. Whilst at the same time, this higher low created the initial low of the day for the dead gap zone. Now, to be 100% confident that this is going to be the initial low of the day for this current day, we would want Asia to open and try to repeat the level without breaking it, essentially giving us a double bottom or a higher low. That would give us confidence that yes, the initial low of the day is in. Now, if you didn't already know, within TTC we have many live sessions per week, with our Asia live session being within the 30-minute gap between the dead gap zone and the start of Asia. So that is this candle here. Whilst our pro traders host live sessions, they also follow that live session up with a chart update. So let's have a look at what NRJ had to say following on from his call. On Monday, he said, for shorts, nothing at the moment, but watching for the spike up into the liquidity. Now, when we look at his chart, you can see that he predicted a small move around 50% of this blue vector candle before anticipating a breakout to the upside. So how did that chart play out? If I am to draw a box around this blue vector candle that Jared had marked out in his chart, price came down, held 50% of that blue vector candle before pushing out to the upside. You can see he absolutely nailed it, giving our members the entry for false move week beginning. So once we got the W formation, we count our levels because false move week beginning is ideally a day trade played out on the 15-minute time frame. So if we look here, we have a rise level 1, a rise level 2, and a rise level 3, with these 3 moves being supported by volume. US session then set the high of the day for Monday. So what is the high of the day? The high of the day is simply the highest point price moved the day prior, and the low of the day being the lowest point price moved during that day. During the move up on Monday, open interest starts to rapidly climb, taking the delta from 11.13 billion to the shorts at market open, meaning 11.13 billion worth of short positions were at risk of being liquidated if price was to make a sharp move to the upside, to then swinging it long, which then built the delta to 5.36 billion to the long. So although this may not seem very high, we can see that the damage has been done in taking out the short position, whilst at the same time flipping that delta to induce long positions, bringing it to 5.36 billion to the longs. Now, before we jump into what happened on Tuesday, I want to zoom out for a second because there were two really important posts dropped on our website on Monday, and both of them add some context to this week's movement. First, Jared, our in-house economic expert, posted a blog that kind of hit like a quiet bombshell. Basically, the World Bank downgraded global growth for 2025 to 2.3%. And while that number doesn't sound crazy, to most people, what it actually means is we're heading into levels of stagnation we haven't seen since 2008. And according to Jared, this isn't just about trade wars or bad policy. It's something deeper, a structural issue where the global economy has kinda forgotten how to grow. Like, even with all the stimulus, all the rate cuts, all the efforts to reboot things after COVID, the data just keeps getting weaker. One of the craziest things he pointed out was the Swiss bond market. Like, 2-year yields are now 20 basis points below zero. That's not normal. The Swiss franc is holding strong, yields are dropping, and bond curves are basically screaming deflation. Then, when you combine that with the US inflation data, if you strip out that shelter component, it just confirms what the market's been quietly saying for months. Demand is weak, recovery is stalling, and this decade could end up being even slower than the 2010s. So, why does that matter to us? Well, trading in an environment where the big narrative isn't necessarily about recession anymore, it's about structural decline. And when you know that's the backdrop, it makes you approach things a little differently. You're not chasing hype, you're looking for high quality setups with confluence, and you're more cautious with risk. Now, alongside that, Silverwolf also dropped a blog, and this one was more focused on geopolitics. He broke down the tensions between Iran and Israel and how crypto is getting caught in the crossfire. In theory, decentralized assets like Bitcoin should thrive in these moments. People lose faith in governments, traditional currencies, and central banks, so they turn to assets like BTC. But in the short term, that's not what always happens. Like, within 24 hours of the escalation, we saw over 1.1 billion in liquidations, with 335 million wiped in 1 hour. Mostly longs. That right there tells you how reactive and emotional the market can be when war headlines hit. Silverwolf also reminded us that crypto is still treated like a risk asset by most of the world. So even though we might be confident long term, the broader market still treats Bitcoin as the first thing to dump in uncertainty. It's the flight to safety mentality, and crypto doesn't always get counted in that group just yet. But here's the part I really liked. He reminded us that cash is a position, and that sometimes the best trade is doing nothing. Holding stablecoins during chaos gives you flexibility, and right now that's more valuable than trying to force trades through unpredictable macro. He finishes the blog off by saying sitting on the sidelines isn't weakness, it's patience. It gives you options, and in high stress environments like this, flexibility is a weapon. And this week was a good reminder of that. From here, we went into our multi-day, multi-session M formation after 3 level rises that triggered our 3-day swing to the downside. Now, to be completely honest, I would have preferred that we got another lower high in the gap or the Asia session for a perfect entry to catch this reversal, because we know the moves that happen in the dead gap zone can be highly manipulated. Regardless, we've seen this big volume come through to break the 50 EMA. Now, whilst this candle was open, our community was all over it. Before this red candle even had a chance to close, one of our OG members, Fitz, posted a real-time update, the Donald Trump post, mentioning everyone should immediately evacuate Tehran. Now, if you trade the model we trade and you see 3 level rises and a reversal pattern, then this drop here would not have scared you, regardless of the news that had come out. And we would have been looking for a reversal anyway. And this is why we always say, pay attention to the model first, everything else is just noise. So again, we apply the model and we count this drop through the 50 EMA that was triggered from Trump's tweet, and we have a drop level 1. So now it is Tuesday and it is my turn to host a live trading session where we hunt for setup to trade live together. This W formation, false move, week beginning, rise level 1, rise level 2, rise level 3. We have a drop level 1, all of this being a drop level 1, and we may get something like this, drop level 2, and then we really have to reassess, because if it drops the EMAs, this area of interest, with volume, it's not going to look good, because then we have a drop level 2. If it can't make it back above the 200 EMA, then we'll be looking for this, and that'd mean that all of this is false move week beginning. Now, I haven't looked at this, so we're kind of doing it together on the call. So on this live trading session, we were looking for a retracement back to 50% of the 4-hour vector. And during the live trading session, we were looking for a scalp to then looking for signs of the Asia initial high of the day setting in this area to then give us an entry short in anticipation of drop level 2. So if I go to my chart update following on from that call, you can see look for weakness around 50% of the 4-hour vector where the scalp long target is. If we get weakness there, then we may get a drop level 2 for the 15-minute time frame. And if we get this, we need to reassess and see how strong the volume is and zoom out to see how candles are closing on the higher time frame, as it could be the start of the 3-day swing, and the move up yesterday may have just been false move week beginning. So let's go and have a quick look and see how this setup played out. So if I go back to the 4-hour time frame, this is the vector candle I was referring to. During the live setup, I was looking at this blue vector candle and ideally looking for price to hold around 50% of that level to then give us a scalp back up into 50% of that 4-hour vector candle. So if we drop to the 5-minute time frame, you can see we got that higher low that gave us the entry to take the scalp long into 50% of that 4-hour area of interest. As soon as we got signs of weakness, like what I mentioned here, if we get weakness there, then we may get a drop level 2 for the 15-minute time frame, then that would be your signal to exit your scalp long. Also, because we were looking for signs that the initial low of the day was setting. And we have a lot of our members who caught that exact trade. JDF911 caught this scalp long, so did Daisy BS and Zinni. So we banked the profits on the scalp long and looked for the entry for drop level 2 on the 15-minute time frame. From there, we've seen continuation to the downside. The discussion around the move on Monday to the upside was made clear that Monday was more than likely false move week beginning. It just took longer than usual. And the move that we are seeing to the downside is more than likely the 3-day trend. Both Annie and I dropped updated charts around here, warning that this week could get tricky with volatility potentially sparked by just a tweet. Now, with FOMC being pretty much a non-event, it was clear to identify that we were in a sideways consolidation that has now lasted 2.5 days. Now we move into Thursday's price action. By now it is clear to all of us in TTC that we are in a boardroom, which is essentially sideways consolidation. We call it the boardroom because this is when the market makers come back to the table, they assess where the liquidity is, they build their own position and accumulate contracts before they make the fast aggressive move out. We also call it the board room because this is where we essentially just get bored. And where other traders would get bored into opening a position, predicting a breakout of the sideways consolidation. With the expectation of more levels to come, Annie put out another update to the community with a video explaining her thoughts around a level 3 still coming. She talks briefly about a conversation she was listening to on Twitter Spaces.
Look, first of all, it's very rare that everybody agrees on those spaces. It's usually very emotional and there's fighting and it's quite hard to hear. It actually gets really annoying. But last night, there seemed to be agreement from most people, and there seemed to be one person in particular who was from the military that was very well respected by everybody listening. Now, what he was saying was that basically, it's not over, and it's getting to the point that America is going to have to get involved. And he was explaining certain moves that they're making now that is a hint that they're getting ready to get involved. However, what he said was America's not going to want to get involved in a long drawn out war. They're going to come in, they're going to make a big aggressive move, and they're going to end it. And in his opinion, he believed that was going to happen within 96 hours.
At the same time as Annie giving our members within Discord a live video update of her thoughts, we also have Jared, our macroeconomist, share with us that Friday is on track to be the biggest options expiry ever at 6.8 trillion. So what does this chart mean? Well, this is showing us the options positioning across the entire market heading into the big expiry on June the 20th, which is today as I am filming this. There's a total of 6.8 trillion worth of open options contracts set to expire, and the bulk of that, nearly 4.5 trillion, is sitting in the S&P 500 alone. That's a huge amount of money. Now, if you look closely at these bars, they show us how many of those contracts are calls versus puts. Calls are bets that price goes up, and puts are bets that price goes down. And what's really interesting is that most of the positioning is skewed towards the puts, which is bearish.